Welcome to my Accounting 1120 discussion on long-term bonds. It has just dawned on me that I did the last couple pencasts without my headset on, and you probably hear scratching of the pen. I'm sorry about that. I was determined to sit by the fireplace, and I forgot to bring my headphones and didn't notice it till just now. But the headphones are on, and it's snowing harder than ever. Let's get on with it. So, we have a goal today. And my goal today is to discuss with you exactly what a bond is. Lots of students freak out when you say the word bonds payable. And if you say premium or discount, they freak out even more. And I am setting out to break that habit. So, what is a bond? Well, first of all, it's a way for the issuer of the bond to borrow money. And it's a way for the investor who buys the bond to make investments. We're going to look at the issuer side during this pencast because it is a chapter on long-term debt. We'll talk a bit about the investor side when we get to investment chapter. So, what the heck is a bond? Let's break the mystery around it. First of all, whenever a bond is issued, an indenture is made. And an indenture is a contract under which the bond is issued. And the indenture gives you the specifics of the bond. It will tell you the face value of the bond. Bonds are usually issued in $1,000 increments. And there are a lot of them issued at once, so I'd be issuing 10 here. But I'm just going to treat it as though this is one bond, make it easier. It happens to be 10,000 because it makes numbers big enough to work with. The stated rate of interest on this bond is going to be 10%. I like 10% because it's easy for us to see what we're doing. And it pays interest semi-annually on June 30th and December 31st. That makes the accounting a little bit easier as we're first learning to do bonds. So the indenture tells you the face amount of the bond, the stated rate of interest, and how often it's paid. And then it will tell you the length of the bond. And this is a 2-year bond. Now most bonds are issued for 20 or 30 years and they're long-term borrowing and investing agreements. But I have a desire to amortize these bonds down to zero with you, and I don't feel like doing amortization schedules that take up 45 pages. None of us would be happy. So, here's our bond, described under the indenture, and this bond has certain cash flows, and these cash flows will never change because they are determined by a contract. They are contracted. If you violate the contract, you can be put out of business for that. People like bonds because bonds are just a really nice way to invest money. So, first of all, our bond has a stated rate. If the stated rate is 10% and it pays interest semi-annually, divide that by 2 to be twice a year, and it will be 5%. And since it's a 2-year bond, it will have 4 periods because we're doing it semi-annually. So like we divided by 2 to get the interest rate, we'll times by 2 to get the number of periods. So we're going to borrow $10,000 and let's issue it on 12/31/13. That's coming right up. Then it will pay interest on 6/30 and interest again on 12/31/14. Then interest again on 6/30, and then it will pay off on 12/31/14. I believe I messed up this year. Yes, because there are 2 periods, 6/30 and 13. 12/31, still 13. Here's our first year. 6/30 and 14, and 12/31 and 14. And this bond would pay $500 at 5%, take $10,000. times that by 5%, you'll get 500, and it pays that interest every 6 months because it's a semi-annual bond, and it happens for 2 years, and then it pays, the issuer has to pay it off. So this is the cash flow from the issuer's perspective. Of course, it would be the opposite for the investor. And this cash flow is cast in stone because it belongs to this indenture and it's never going to change. So, the cash flow is determined by the indenture, and it never changes. And the indenture is the contract. So the cash flow never changes. So we're going to use that cash flow for our examples, and it's never going to change. It's a contracted amount. So, what do we know? We know we have a $10,000 bond that's 10%, and that's never going to change. So we have a bond, and it's 10%. It pays $500 every 6 months until it matures. And then it pays out the $10,000, and it doesn't change. It's the same forever. But what does change is the market rate of interest. It wouldn't be uncommon for the market to change during the time we were putting this bond in place. It takes a long time to get a bond out the door. You have to hire someone, they have to print the certificates, then they have to sell it, then you get your money, and then that probably takes 6 months, and probably a pretty good bet the interest rates are going to change during that period of time. So, our bonds stated rate to start with is 10%, and it's in all likelihood that the market rate, or the market yield, is 10%. We would say that this bond is going to sell at par value, because the market rate and the stated rate are the same. We would say it would sell for 100%. That will become more evident what I mean in a second. And if that's the case, we would get $10,000 for our bond, and we would set up a bond payable, notice my abbreviation BP, for bonds payable, of $10,000. Well, let's say the market wasn't at 10%. Let's say our bond stated rate is at 10%, but the market's yield, or stated rate, dropped to 8%. Our bond is very valuable now because it's paying more than the market's offering. We would say that this bond would sell at a premium, and I'm not going to show you how I calculated the amounts because that goes beyond the scope of this book, but I will show you this. It's going to sell at 103.63. You can times that by the face amount of the bond, and that's how much cash you're going to get. So we're going to get cash in the amount of $10,363, and we're going to issue a bonds payable in the amount of $10,000, and you always record the face amount of the bond and bonds payable, and then I'm going to set up a bond premium in the amount of $363, and I am going to charge the investor an additional $363. And that is exactly how much it takes to change the 10% I have to pay down to the 8% that the market is demanding. So this is quite literally the difference between 10% and 8%, and I'm going to use that to offset interest expense when I amortize this bond. Well, that's kind of interesting, isn't it? We'll get on with that a little later. Let's move to the other example, though. This is our bond selling at a premium. This is our bond selling at a par. How about the opposite, when the bond needs to sell at a discount? That happens when the bond's stated rate of 10% is less than the market is demanding. Let's say the market is demanding 12%. Our bond isn't going to be a very good investment for someone, so we're going to have to sell it at a discount. We'll have to sell this bond at a discount, and the amount we're going to sell this bond at would be shown as 96.53. And that is something I calculated for you. It is accurate, but we're not going to go into how. So we're going to get cash in the amount of 96.53. That tells you how much cash. And we have to set up a bonds payable at 10,000. The difference is going to be a bond discount. It's a contra account to bond, or actually it's an adjunct account to the bonds, and it is in the amount of something. I forgot to figure it out. Let me see. 347 will make that work. And that is exactly the difference between 10% and 12%. Not kind of, but exactly. And I'm going to use that to increase my interest expense over the life of the bond. And when I sell it at a discount, I don't get the full face amount. And that's because I'm giving them the difference in interest right up front. So that's an interesting thought. You know, here's the deal. Bonds have a stated rate, and it can't change. The market changes. And the way that we can still sell bonds is by changing how much we sell them for. We change them by an amount that makes the investor get exactly what the market rate is. In the case of our premium, we had to sell it more so we could change the rate of interest from 10% to 8%. In the case of and that was our premium. In the case of our discount, our bond only pays 10, and we got to drive the interest rate up to 12% so we sell it for a little less. And we put in the premium account or the discount account the exact amount that we need to change it by to get the investor's rate of return where the market is demanding. So that's enough of a discussion on bonds. Let's review. A bond is a cash flow stream that someone sells to borrow money and someone else buys as an investment. Its cash flows is determined by the indenture, and that never changes. But the market rate of interest changes, and so bonds can sell for more or less so that it matches up with the market rate of interest. And bonds are a lot like stocks in that they have a secondary market. Once you issue a bond, it can change hands. People can buy it and sell it and buy it and sell it and buy it and sell it until finally the bond matures. And the way that we adjust the sales price in all those events is to calculate how much the bond should sell for, so it would give you the exact stated rate of return the market demands. So that's my discussion on what is a bond. I would like to move on to do the accounting for bonds. Premiums, discounts, and at par value. Thanks for joining me on this snowy, cold day. Hi, and welcome back to the land of the tundra, where today we're going to continue our discussion on long-term debt. Our goal in this pencast is to demonstrate the accounting for a bond sold at par value, or 100%. Another way to say that is the bond's stated rate, and the indenture is equal to the market rate. So there will be no bond premium or discount. We'll start with the easy one. My bond indenture says it's a $10,000 bond, I'm going to use the same bond all the way through. Pays 10% semi-annually. You get the drill. And you know by now that it kicks out a cash flow stream that's 2 years long, where it pays interest every 6 months. That we borrow $10,000, we pay interest in the amount of $500 every 6 months, and at the end of that time, we pay off the bond. If this were a real bond, that would probably be 30 years long, 2 times a year, amortization schedule 60 lines. We're not doing it. So, here's our cash flow, and that's never going to change. Those are our facts for this bond. Now, I could make an amortization schedule and analyze this. Say that word, amortization schedule. But you know what? It wouldn't provide any useful information on a bond sold where it's sold at par. So I'm just going to make the journal entries based on our cash flow. I'm skipping the analytics and going right to journal entries. Don't do that too often. In this case, we're all right. Let's first record the fact we borrowed money. We'll get some cash, and we'll have a bonds payable in the amount of $10,000. Our first journal entry. 6 months later, on 6/30, guess we should put dates on this. We issued this bond on 12/31/13. Let's get dates on it. See if I can do them right this time. On 6/30 and 12/31/13. I guess we're issuing it on 12/31/12, huh? Bite me. Just remember that for the past PenCast. And we have 6/30 payment, 12/31 payment, 6/30 payment, and a 12/31/14 payment. I hate it when they screw up dates. Just going to have to remember that for our first PenCast. I think I have them off by a year. I can go back and change it. I'm doing that right now. I don't know if it'll work or not, but it's changed. We're back. I probably should have shut this off to do that. Ha! Oh well. Let's make our first interest payment. On 6/30/2013, we pay interest expense in the amount of $500, and it equals our cash payment. And our bond, we didn't sell at a premium or a discount, so we're just forking over the interest payments. On 12/31, you would make another interest payment. Interest expense and cash, $500. And I'm not going to keep doing that because I think it'll make you crazy if I do. So you would make 2 more of these. Exact same entries right here. One on 6/30/2014 and one on 12/31/2014. And then the last entry, you would pay it off. So on 12/31/14, you would just say bonds payable debit $10,000 and credit cash $10,000. So I just skipped these 2 payments because they're the same, and I went right for the last payment where we paid the bond off. How would this look on our balance sheet? Well, it wouldn't matter where you looked at it because there isn't a premium or discount changing the amounts. Under long-term debt, you would show a bonds payable in the amount of $10,000. And that wouldn't change because you're not amortizing a premium or a discount along the way. So that was a fast PenCast to show you how to do the accounting for a bond when it's issued at par value. Thanks for joining me.